Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video we're going to be going over FAR Area 1, and this is Section E of FAR Area 1, and this is an application topic. Prepare financial statements using the cash basis or modified cash basis of accounting. And we're going to be doing that the SuperfastCPA way, which is diving straight into questions to learn the material. If you don't know much about our strategies, that is one of our main strategies, going to the questions first, because what are you going to be doing on test day? You're going to be answering multiple choice questions and doing sims. So why spend hours watching lectures? Why spend hours reading through textbooks when the most important thing you could be doing is learning how to answer questions and how to learn from those questions? So that's one of our big strategies, and you can learn more about our strategies if you go to SuperfastCPA.com and watch our free 1-hour webinar training. We go over the key ingredients to passing the CPA exam, and again, it's only 1 hour, it is free, and we will show you how to pass the CPA exam without wasting months or even years of your time. Make sure you go check that out, and also just letting you know, we will only be going over 5 questions in today's video, whereas SuperfastCPA members will have access to the full 10-question video when we post it in the members forum. So if you like this and you like our other videos, just remember that after going and watching that SuperfastCPA webinar, if you become a member, you'll get access to all these full 10-question or maybe sometimes even 12-question videos, so you can get more practice and more learning among our other strategies and other materials. With all that, let's go to the first question. All right, here we are at question 1, and something I want to say up front is this topic seems to be a topic that is more likely to be tested as a sim, but there could definitely still be some multiple choice questions about it because it's an application topic. But I tried to approach these questions by kind of making them almost part of a sim, like kind of what I think you might see if you saw a larger sim. These multiple choice questions might be parts of those sims that you see if you do see a sim about preparing cash basis or modified cash basis financial statements. So just want to throw that out there at the beginning. Let's dive into question 1. Something we always recommend is going to the very bottom of the question to see the real question, and that will give you context so you know what you're looking for as you read through the full thing. So based on this information that we're about to read, what is the company's cash basis income for the year? Okay, so we want to read through this focusing on cash. A small business is preparing its cash basis financial statements in the year or for the year. Throughout the year, the company recorded $85,000 in sales on credit and accrued $52,500 in expenses which have not yet been paid. The business received $92,000 in cash from customers and paid $48,250 in cash for various operating expenses. At year end, the company also prepaid $3,000 in rent for the next year. So again, based on all this, what is their cash basis income? Now, this is something that's probably not too difficult for this topic. I bet that just by reading through this, you could probably figure it out. If not, that's okay though. We're going to go ahead and go to the answer to kind of get a base for the rest of this video. All right, here we are. The answer is B. $40,750 would be the cash income. So let's walk through this. It's pretty straightforward. Under the cash basis of accounting, only cash transactions, cash received and cash paid, are relevant and the accruals are ignored. So cash received from customers, even though there was these sales on credit and these accrued expenses, all we care about is that they received $92,000 of cash, paid $48,250 in expenses, and then we also pay attention to this prepaid rent because even though it's prepaid, you still have to pay cash to have that as a prepaid expense. So that's a cash outflow when it comes to cash. So you take the cash from customers, subtract the cash from operating expenses and the prepaid expense or the prepaid rent, and that gives you $40,750 of cash income. Now again, it's pretty straightforward. What you always need to focus on when it comes to cash, not necessarily modified cash, but cash, is money given, money received. That's it. Let's go to the next question to kind of expand on that a little bit. All right, here we are at question 2. Again, always read the last part. Based on this information, what is the company's cash basis income for the year? So very similar, but let's read through and see what the differences are. A small manufacturing business prepares its financial statements using the cash basis of accounting. During the year, the business made $250,000 in sales, all on account. The business also purchased $100,000 of inventory on account. Other operating expenses for the year amounted to $60,000, of which $45,000 was paid in cash. The beginning balance for accounts receivable was $30,000, and the ending balance was $50,000. The beginning balance for inventory accounts payable was $20,000, and the ending balance was $10,000. The ending balance for inventory was $80,000. So with all that information, we have to figure out how much cash they spent and how much cash they received, but we're kind of really only given a lot of information about the receivables and the payables. Now, this is something you've probably dealt with in just normal financial accounting quite a bit. If you have an idea of how to do this, that's fantastic. Pause the video, do the calculation, and come back when you're ready. If not, again, let's dive straight into the answer to start learning from this. All right, the answer is A, $75,000. That's how much cash income there is. So let's walk through this. To determine the cash income, we focus only on cash received and cash paid. Inventory doesn't affect cash income because if you think about it, the inventory itself, you spent money to buy it, and then you're getting money from selling it, but like the inventory itself doesn't affect cash. So we don't pay attention to that $80,000 that was left in inventory at the end. Let's read through the rest here though. To figure out the cash from sales, we start with the beginning accounts receivable. Then we take those sales made on account. So that would be $280,000 of accounts receivable that we have sitting around. But then the year ended with $50,000 in accounts receivable. So we subtract that ending balance from the beginning and the sales put together, and that gives us $230,000 of cash income. Now, of course, there maybe could have been like bad debt or something like that, like receivables that didn't go through, but that's kind of beyond the scope of this topic. But it's pretty simple. You take the beginning accounts receivable plus the sales on account, subtract the ending balance and that shows you how much money they actually received from those sales, $230,000. And then you do a similar thing with the cash paid for the inventory, the payables for the inventory. You take the beginning inventory accounts payable of $20,000, you add the purchases that they made on account for the inventory of $100,000, and then you subtract the ending accounts payable of $10,000. That gives you $110,000 of cash paid for these purchases. But it did also mention that the other cash expenses were $45,000. And if you noticed up here, they did mention that they had other expenses, but only $45,000 of those were paid in cash. So that's the amount that we're focusing on right there. So we add the total cash from the purchases and the cash from the expenses up together, and then we subtract it from the total cash received, and that gives us $75,000 of cash income for the year, even though we were really only given a little bit of information about accounts receivable and accounts payable and things like that. Now, these first two questions were kind of simple, making sure you understand the idea behind cash accounting. For the next few questions, we're going to focus on the differences between making a financial statement for cash and making a financial statement for modified cash accounting. So let's go ahead and go to question 3. All right, here we are at question 3. Now let's read this last part first. How would these transactions be recorded under cash and modified cash accounting, and what impact would they have on the business's net income and liabilities for the year? So as we're reading this short blurb here, we need to be thinking about how this is going to work with cash and how this is going to work with modified cash. A small construction company purchased a truck for $30,000 in cash at the beginning of the year. The truck has a useful life of 6 years with no salvage value, and the company uses the straight line method for depreciation. Additionally, in the middle of the year, the company incurred a $10,000 loan to purchase additional equipment, which will be paid off in monthly installments over the next 2 years. By the end of the year, the company had made 6 monthly payments totaling $3,000, including $500 in interest. So that $500 is included in this $3,000. So again, with all that information, how are these going to be recorded under cash and modified cash? And what is their impact going to be under cash and modified cash? They are treated differently, and if you don't really know how that works, that's okay. That's kind of the point behind this question, to kind of dive deep into it. If you do have an idea though, pause the video, kind of think through this and think how these would be treated differently under cash and modified cash. And when you're ready, come back, we'll dive into it together. All right, here we are. The answer is A. Under the cash basis, the expense would be $30,000 for the truck and $3,000 for loan payments. There would be no liabilities recorded, and so that would be a net income decrease of $33,000. And under the modified cash basis, they would depreciate $5,000 for the truck, record $7,500 as a liability, and again, this is at the end of the year, and they would have a net income decrease by $5,500. Now, this is kind of an involved question, and that's the idea behind this question and the next two questions, is kind of to almost take a multiple choice question as if it was a part of a sim, and that's why this is a little bit big and involved. Let's look at the explanation to kind of see what the difference is between cash and modified cash. For cash basis accounting, it's pretty simple. The entire cost of the truck, the full $30,000, is expensed in the year of purchase since cash was paid, reducing net income by $30,000. So they paid cash for it, that's the expense. The loan payments totaling $3,000, including $500 in interest, are also expensed since they involve cash outflows. You just take the full amount that was paid for those loan payments, and that is also an expense. So take the $30,000 for the truck that was expensed and the loan payments that were expensed, and that's $33,000 that will reduce net income. Liabilities are not recorded under cash basis accounting, so the remaining loan balance of $7,500, and if you think about it, that's the $10,000 loan less the $2,500 loan principal that was paid, because $500 of the $3,000 was interest, so $2,500 of it was loan principal. That's not recognized. They just recognize it as the payments are made. That's the only thing that shows up on the cash basis financial statements, is them paying off that loan, those expenses. That's all they record there. They don't record the liability. So that's one thing you want to keep in mind when it comes to cash accounting. The only asset that's recorded is cash. No liabilities are recorded. Remember that for cash accounting. Now let's scroll down a little bit to talk about modified cash basis accounting. And then I also will kind of just talk about modified cash basis accounting in general, because we didn't talk about it too much in the previous video, because really, as far as the previous topic where we were talking about converting cash to accrual, the main focus was focusing on cash to accrual, not really modified cash to accrual. But I still want to explain what modified cash accounting is in this video. So let's talk about modified cash basis. In this situation, they would capitalize and depreciate the truck. So they have straight line depreciation. They would have, again, and this was purchased at the beginning of the year, so they would have 6 years, including this year, and that's 30,000 divided by 6 years. That gives $5,000 of depreciation per year. So the net income decreased by $5,000 due to that depreciation expense. And again, this is for modified cash basis accounting. Only the interest portion of loan payments, the $500, is expensed, reducing net income by an additional $500. And that's very similar to accrual accounting. If you remember, interest is an expense, but then the remaining debit is actually a debit to the liability, to the loan. So $500 is going to be an interest expense, and then the remaining loan balance of $7,500, again, that $10,000 less the $2,500 loan principal that was paid, is recorded as a liability, since modified cash basis allows for recognition of certain accruals such as long-term debt. So that's a big difference between cash and modified cash, is that cash doesn't record liabilities, doesn't record really anything like depreciation or anything like that, whereas modified cash has that ability to record these depreciable assets, to capitalize them, to record liabilities, and debit those liabilities as they're paid off, more similar to accrual accounting. Now, with all that said, that means the total impact to net income is that $5,000 depreciation and that $500 interest. That's why it's $5,500 there. Now, if you're looking at modified cash basis of accounting and thinking that just sounds a lot like accrual accounting, it is very similar to accrual accounting, and that was a question that I was kind of thinking about as well. So this is a note that I wanted to kind of talk about. What is modified cash basis? It combines elements of both cash basis and accrual basis. So again, it's kind of a mix of the two. Revenue is generally still recognized when cash is received, similar to cash basis. So when you receive cash, that's still kind of typically when you would recognize the money. That when you would recognize the revenue under modified cash is when you receive cash a lot of the time. And that is different than accrual, which is why this is not accrual accounting, but it's kind of close. Now, the big difference between modified cash and cash accounting is that with modified cash accounting, you can allow for some accruals, such as accounts receivable sometimes, accounts payable, and prepaid expenses. And some expenses can be recognized when they are paid, but some expenses are also adjustments like depreciation of long-term assets and recognition of certain liabilities. So modified cash can take into account, as we saw in this question, depreciation, liabilities from loans, and things like that. We're going to talk about some other differences in the next questions. But as you can see, cash is very straightforward, the cash basis of accounting, whereas modified cash basis is a lot closer to accrual accounting, but there is kind of a few small differences in how they treat it, especially for revenue, where modified cash typically a lot of times still recognizes revenue only when cash is received. But we're talking about some of the big differences between cash and modified cash, so you know how to prepare a financial statement on either one if you saw a sim like this. So let's go to the next question to learn some more differences between cash and modified cash. All right, here we are at question 4. As always, read the last part. Calculate the cost of goods sold, or COGS, under both the cash basis and the modified cash basis, and determine the difference between the two totals. Okay, so we're going to have to calculate both the cash and the modified cash basis for this. A retail business operates on a cash basis, but is trying to decide whether to switch to using the modified cash basis. During the year, the business paid $80,000 in cash for inventory purchases. Additionally, it paid $20,000 in cash for inventory that was received in the previous year. The business began the year with $15,000 worth of inventory and made $100,000 in inventory purchases throughout the year. at the end of the year, the business had $25,000 worth of inventory on hand. So with all that information, again, we have to calculate COGS for cash and calculate COGS for modified cash and determine what the difference is between the two. Now, based off what we talked about when it comes to cash, you probably could figure out the cash COGS pretty easily, would be my guess, but you might not know how to treat modified cash basis when it comes to COGS. So if you have an idea, go ahead and pause the video and do the calculation. If not, that's okay. Let's go ahead and look at the answer together. All right, here we are. The answer is B. $10,000 would be the difference between the cash COGS and the modified cash COGS. So let's talk about this. Cash basis COGS, super straightforward. Cash paid for inventory purchases in the current year, $80,000. Cash paid for inventory received last year, $20,000. And again, this is the cash paid in the current year, so that just is $100,000 right there. Under the cash basis, COGS includes all cash paid for inventory, regardless of when it was used or sold. So it doesn't matter how much inventory you sold this year. It doesn't matter if you are receiving inventory that you paid for last year, but you're only just now receiving it. What you're focusing on is, did you pay for that inventory this year? And that is going to be the COGS under cash basis. Under modified cash basis, this is a lot more similar to what you're probably used to under normal financial accounting. COGS is the beginning inventory plus the purchases less the ending inventory. So you take the beginning inventory of $15,000 plus the purchases of $100,000 less the ending inventory of $25,000, and that gives you a total of $90,000 of modified cash basis COGS. So what's the difference between the two? $100,000 less $90,000 is $10,000 difference. So that's why B is the right answer. But as you can see, modified cash is pretty similar to how you would normally calculate COGS. So remember that. But cash, again, all it ever cares about is, did we pay money for it this year? If not, then we don't include it. If we did pay money for it this year, then that's what's going to be included in the calculation. So I just hope you can kind of see that pattern here. Let's go to the next question to learn another difference between cash and modified cash. All right, here we are at question 5. As always, read the last part. What is the interest expense for the year under the cash basis of accounting? And what is the income tax expense for the year under the modified cash basis of accounting? So it wants us to figure out two different things on two different bases of accounting. So kind of interesting there. A small business uses cash basis accounting, but is considering switching to the modified cash basis. During the year, the business took out a loan of $50,000 with a 6% annual interest rate, with interest payable semi-annually. The first interest payment, which was $1,200, was made halfway through the year. By year end, an additional $1,300 in interest has accrued, but has not been paid yet. Additionally, the business owes $8,000 in income taxes at year end, which will be paid in the next fiscal year. So a good amount of information here. There's a loan. It tells us how much they've paid in interest, and it also tells us how much has accrued, and we also know how much of income taxes is accrued. So under cash basis, with this information, what's the interest expense? And then under the modified cash basis, with this information, what's the income tax expense? Pause the video. I think you can probably figure this out based off of what we've learned in the previous questions and even in the previous video. And when you're ready, come back, we'll look at the answer together. All right, here we are at the answer. The answer is A. The interest expense under cash basis would be $1,200, and the income tax expense under modified cash basis would be $8,000. But we're going to, of course, go over how these would be treated both ways. So let's go ahead and scroll down a little bit to kind of focus on the explanation here. So for the interest expense, and again, I think this is pretty clear and obvious by this point, so hopefully this makes sense. Cash basis, under the cash basis of accounting, expenses are recognized when they are paid. That's it. Since the business made only one payment of $1,200 during the year, this is the only amount recognized as an expense under the cash basis. So for cash basis, the interest expense is $1,200. But for modified cash basis, which again is quite similar to accrual in a lot of ways, and you could get confused between modified cash and accrual, which is why I was explaining it in question 3. Modified cash is still a little bit different than accrual, especially when it comes to recognizing revenue. But if you know how to do accrual accounting, you'll know how to do a lot of modified cash basis accounting, because modified cash basis does allow for certain accruals, such as accrued interest. Even though the additional $1,300 in interest has not been paid, but only accrued, it is still recognized as an expense under the modified cash basis. So you take the interest paid plus the interest accrued, and that's $2,500 under modified cash basis for the interest expense. Now let's talk about the income tax expense. Very similar. Cash basis, they are only going to recognize it if it's been paid. since it's the $8,000 in income taxes hasn't been paid within the year, it is not recorded as an expense in the current year. So under cash basis, it would be $0. Under modified cash basis, you can accrue that income tax expense. Even though the $8,000 in income taxes will be paid in the next fiscal year, it is recognized as an expense in the current year. So because it's accrued, they recognize that as an $8,000 expense for income taxes. So I hope you've been able to kind of see cash basis accounting, pretty straightforward. All you care about is the cash received, the cash paid. Modified cash, a lot closer to accrual accounting, still has a few things from cash accounting, mainly how the revenue works. But again, I hope this has all made sense so far. So to kind of help it sink in a little bit, before we go any further or do anything else, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, because again, remember, we're focusing only on the questions most of the time, you will notice the things that keep popping up. You will notice the things that are obviously important from the questions. You've seen 3 questions trying to teach you how to calculate cash income. You've seen 4 questions trying to teach you how to do cost of goods sold between modified and cash basis. Just different things that pop up in your review course, the things that are obviously important because you are seeing them in the questions multiple times. So you take a moment, either during or after you're studying, and you write down these pillar topics in your own words to kind of summarize what you learned and what was most important from the questions that you went over. So let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just go through it. Again, this is kind of a summary, basic summary of the most important things you learned. For the net income calculation on cash basis, very easy. Recognizes revenue and expenses only when cash is received or paid, ignoring accounts receivable and payable. Now, you can still use accounts receivable and payable to calculate the cash that you received, but you're not taking, like the accounts receivable and accounts payable don't themselves affect the cash. For property, plant, and equipment treatment, cash basis expenses property, plant, and equipment fully in the purchase year, while modified cash basis capitalizes and depreciates over time, kind of like normal accrual accounting, right? Liabilities recording, cash basis doesn't record liabilities. That's a big thing. Cash basis does not have liabilities, whereas modified cash basis recognizes certain liabilities like loans and their payments. Now for COGS calculation, cash basis includes all cash paid for inventory, and that's it, while modified cash basis considers beginning and ending inventory to match costs with revenue. Again, kind of similar to accrual accounting. Interest and income tax expenses, cash basis recognizes these expenses only when paid. Modified cash basis accrues and recognizes them even if unpaid. Now, these are some of the biggest differences between cash and modified cash. Remember that modified cash is not accrual accounting, but it has a lot of similarities, and cash basis is just very straightforward, only focuses on cash received and cash paid. Now, those were the pillar topics to help you understand how to prepare cash basis and modified cash basis financial statements. And again, we only went over 5 questions to do that, but if you liked this and you like our other videos, just remember that SuperFast CPA members will have access to the full 10-question video when we post it in the members forum. So if you like this, you can get more of it by becoming a SuperFast CPA member, and the best way to go about figuring out how to do that is to go to SuperfastCPA.com and sign up for our free 1-hour webinar training where we will teach you some of the key strategies to passing the CPA exam. And then after that, you'll have a better idea if you want to become a pro member of SuperFast CPA. If you liked the video, make sure to like it and leave a comment. And with all that, thank you for watching. I hope this was helpful, and I will see you in the next video.